Thank you for tuning in to another episode of Retire Right. I'm Ryan Wyatt, per usual, joined by Ron Wyatt and Nick Lewandowski. The three of us are wealth advisors here at the firm. Ron Wyatt is head of the investment committee. Nick, in addition to being a wealth advisor, supports Ron in his investment endeavors. Today, what we're going to do is we are going to talk about 7 investment mistakes. You can treat this as kind of like the official Wyze Wealth Advisors top 7 investment mistakes, if you will, that we see people that are, getting closer to retirement or recently transitioned into retirement. These are 7 common mistakes we see people making. So I'll take it from the top. The first mistake that we're going to cover, and Nick, I'll ask you to kind of give some additional context here, is keeping an excessive amount in cash over above and beyond really kind of like the liquidity needs. Once that's met, we're talking about amounts held in cash above that. Mm-hmm. Anything that you want to add, any kind of action items that people could take to kind of resolve this?
So some people like to sit on these huge piles of cash, and if it's like 20, 30, 40, 50% of a portfolio, that's a lot of cash. And the issue that you run into is that cash tends not to out-return inflation. I think over the last 100 years since the 1920s, it's about matched inflation. And there are periods where it will underperform inflation. And what that really means is, if you have cash, it's yielding like 4% today, and inflation's 3%, then subtract inflation from that yield, and you're getting a 1% return. A lot of times that's 0. So
well, sometimes it's negative.
Sometimes
too.
It's negative.
Yeah, right. This is actually a unique period of time where cash is above inflation.
Right. So that's the problem, that you end up like treading water against inflation or losing, purchasing power to inflation over time. And the solution to this is fairly straightforward. It's just you focus on holding enough cash so you have an emergency reserve, maybe 3 to 6 months of living expenses, plus any large purchases like home down payments, big car expenses and things like that might come up in the next couple of years. And beyond that, you invest in a portfolio that takes a little more risk, but is also kind of well balanced. We'll talk about that on another one of these topics. So it's just positioning things so that you're making sure you're earning some more return versus having things eroded by inflation.
And I'd like to add one thing is if you include inflation and taxes, long-term, the return of cash has been a lot less than inflation.
Mm-hmm. It's the silent killer, I think. People don't see the cash balances fluctuating, and because they don't see the cash balances fluctuating, they associate safety with that without really considering what's going on underneath the hood. And
Absolutely.
A loss of purchasing power is the main risk that people face.
Absolutely.
There. Mm-hmm. Let's transition to the second mistake we commonly see people making, and that is not aligning your portfolio's risk level or required rate of return, the required rate of return that you need to your time horizon and your spending needs in retirement. Nick, could you also break that one down for us?
There's a couple sides to this coin. So if you take too little risk, we talked about inflation a little bit the last time, but take too little risk, you don't keep up with inflation over 20 or 30 years, mm-hmm. you can have real issues in being able to support the spending. It's like if the investment portfolio is the engine for your financial plan, if you have an underpowered engine, it's not going to work out.
You're not going to put a moped engine inside of a Ford Explorer. Yeah, exactly. You're not going to get very far.
What's the Raptor or whatever that you like? It's not going to work.
Exactly. That's exactly right. So just to give you some perspective on that, if we think about a 3% inflation rate, not very high, by average historical standards, over 14 years at 3%, that's going to double, or that's going to drive prices up 50%.
So that new car you're looking at today, 14 years, 3% inflation, it's going to be 50% higher, the price of it.
Yeah.
Okay.
Over almost 24 years, 23 and a half years at that 3% inflation rate, that car price is going to double. It's going to be 100% higher. So it's no joke, how these numbers kind of compound out over time. So too little risk, you don't keep up with that and you have problems being able to meet your goals potentially. Too much risk on the other side of the coin, then you really risk the capital potentially that you have available. Where this really shows up is when you're taking withdrawals or right when you're on the edge of transitioning to retirement. If you have too much risk in the portfolio and then you have major spending needs and those needs coincide with a big market crash, that can be a plan killer, a devastating thing for a portfolio. So you really have to be mindful of how much risk you're taking in those transitional type periods and when you have big withdrawals coming out of the portfolio.
And the other thing too to keep in mind is that, we use 3% inflation in those examples, but there are certain spending categories, if you will, in retirement that typically inflate higher than that. And there's certain that over long periods of time have inflated at a lower rate than that. But it's very possible that inflation in the short term could be higher than 3%, especially for certain categories. Looking at the third mistake, and Nick touched on this very briefly at the end, but this mistake is people not planning for how much risk they are taking either right before retirement or very early into retirement. This concept is called sequence of returns risk. Ron, could you explain sequence of returns risk and then talk to people about how you would ultimately combat that risk?
Sure. So I'll explain it, but also for people who can view this podcast, you'll see a table that will give you the actual numbers. But let's assume, as an example, that you have $1 million at retirement and you're withdrawing $6,000 a month, $72,000 a year. That's a 7.2% withdrawal rate. Now, I know that's high, but this is just an illustration. And so what we're going to do is show two scenarios. On the left-hand side, what you'll see is a series of returns, and it starts negative and it ends positive. On the right-hand side, it's the exact same returns, just in the opposite order. So they start with good returns and then with poor returns, okay? So you have $1 million, you take out your $72,000, you have the market return, and then we see what's left. So on the left-hand side, you can see after year one, because we fell 16%, your million went down to $768,000. The next year it fell 13%. So now your million's down to $596,000. And at the end of the plan, you end up with $651,000. On the right-hand side, you had two really good year returns. You had the first year was 25% return, the second year 34% return. So your million, even though you're withdrawing money, ended up being worth $1.5 million after the second year. And if you follow it to the end, the ending value is about $1.5 million. So the second scenario, you ended up with about $900,000 more, not because you had a better return, just because of the sequence of returns. I'm sure most of you will find this surprising. First time I've read this study, I was absolutely amazed.
So timing matters, but you can't time the market, obviously. So, and you can't control what's happening in the markets when you retire.
Exactly.
So what do people do?
So what you should do, and this, when you're growing money, this doesn't really apply. It's only when you're withdrawing money.
Right.
Okay. So what you want to do
withdrawing money, or you could also say that people should start focusing on how much risk they're taking if they know they're retiring 3 years from now.
Exactly. Yeah, exactly. And so what you want to do is have a balanced portfolio that would consist of stocks, bonds, and cash. Mm-hmm. Then from there, there'll be income being generated from those investments. You have dividends from stocks, interest payments from bonds, and you can spend that first. So let's just assume that your portfolio is generating a 3% yield, but you need 5%. Okay, so where do you get that other 2%? Well, what we do is when the stock markets are running, they're doing very well, they're getting more expensive, we'll sell some stocks when they're higher to help make up that difference. On the other hand, during a bear market, when stocks have fallen and they're getting cheaper, we don't want to sell assets when they're cheaper. So we'll take it from the safer side of the ledger, which would be your cash and your bonds. And so by doing that, it's much more defensive, right? So the key is plan design. First of all, stocks will not hurt you if, one, you don't panic sell, and that's selling, at the bottom, okay? Or two, if you don't have a properly designed plan. So a plan that can generate the returns, but when the markets fall, do not force you to sell stocks when they're low. And that's the key.
And again, sequence of returns, it's just what we're getting across here is that early in retirement, the returns or the market performance, that's a very crucial time period. And the way that we combat that is making sure that the risk you're taking in the portfolio is appropriate. And then again, looking at, do we trim back on things that are relatively expensive and go into assets that might be cheaper compared to historical norms?
Right, and I'd like to add just one more thing. So studies show that the first 10 years of retirement are crucial. If you can, maintain your portfolio and hopefully grow your portfolio, you tend to be okay because your life expectancy is shorter and you've preserved your capital, right?
Yeah.
That's the key.
Let's transition to the next mistake here. And this is, and we've actually done an episode on this in the past, and it's what we're talking about is focusing on yield and not total return. Or, so that could be chasing high dividend stocks, not focusing on total return, high yield bonds, not focusing on total return. So Nick, could you kind of explain this concept a little bit further, and then, per usual, how are we advising clients in this space?
This, I think, stems from similar things to the cash that you talked about, where people don't want the fluctuation, so they think, I'll find something that pays out a lot of income. I put my principal in that, and then I get this nice fat income stream, and I just don't have to worry about the price moving around a lot. That's what I think ultimately this stems from. So a couple potential issues. When you have something that yields a very high amount of income, you always have to be mindful of whether that's sustainable, where that yield is really coming from. Here's an example. Say I buy a dividend stock at $10 a share, and it pays 50 cents a year in dividends. That is a 5% dividend yield, right? Now say that price is cut in half. $5 price, the dividend yield is now 10%. But the price halved. So the market is saying something is wrong with this stock, but the yield still looks really high.
Yeah.
It's what that really means is that yield's not sustainable.
Right. Are you
very unlikely.
Very unlikely.
Are you buying a good quality stock, or are you catching a falling knife?
Exactly. And you don't want to catch falling knives. So that issue you can run into when you chase yield, so to speak. Another issue is just ignoring the capital appreciation component. So, we think of two sources of return, right? There's the income or the yield, and then there's whether the price is going to go up in the future. A lot of high yielding events don't have a capital appreciation component, but with stocks, for example, there are a lot of stocks that don't have very high dividend yields, but they have very high capital appreciation potential. So if you're not looking at both sides of the picture, you can miss things. And the third component is related to that, because that capital appreciation in taxable accounts, at least, those capital gains, if they're long-term, are taxed at much lower rates than income that's paid out is, than interest income is. So there's a tax efficiency component to being able to get some return, at least in taxable accounts, from income and some from capital appreciation by selling appreciated assets, as opposed to just all income at the higher tax rates.
And it sounds like you're saying you could be leaving some opportunity on the table if you're just focusing on yield and not the total return, because you're neglecting the appreciation aspect of it as well.
And potentially some tax opportunities as well. Yeah, exactly.
The next mistake is, and we talk about this a lot because it's something that we just believe to our core, and two, for our clientele, it's very important, and that is rebalancing a portfolio to manage risk and returns. So, Nick, could you talk about the mistake that we see people make, and again, how we advise people in this area.
No. The mistake is set it and forget it. So you're approaching retirement, say you do, the classic 60% stocks, 40% bond mix, and you get lucky and the stock market just rips higher over the next couple of years. Now you have a portfolio that's 80% stocks and 20% bonds, say, if the market move is really extreme. Well, all of a sudden, you're way out of line with the risk that you set out to take, and you start exposing yourself to like that sequence risk that Ron started saying, depending on the withdrawals that are in the plan. So we don't want that to happen. Like, we set those targets for a reason, and we want the portfolio to stay in line with those targets over time, unless there's a reason in life circumstances that the targets should change. But you have to make a decision about, when you're going to buy and sell to move those things back into target, and how are we going to do that, right? One way of doing it is to do it by feel. I wake up in the morning, news is good, so it's time to buy, or maybe I wait. That's not a process. That's not repeatable.
Motion is not discipline, right?
Yeah, motion is not discipline. So the name of the game here is being systematic. It's a regular, rules-based process. And what you want to do is sell things that have run up in price and that are expensive, and buy things that have come down a little bit in price or cheap. And that's how you get back to the targets you want. Studies show that you should look very frequently at the portfolio to see if a trade is needed, but your rules should be set up in such a way that trades only happen when there's a meaningful impact to do it. How do we think about that? All of the different assets that we own bounce around to different degrees. Bonds don't really bounce around a whole lot in most cases. So a bond rebalance may be set up to trigger when bonds are 10% from their target. Stocks bounce around a lot. So depending on the portion of the stock portfolio, maybe 20 or 30% off of target triggers a rebalance. And then we are looking at this at least monthly, but there are also periods where just markets in general are much more volatile. And in those periods, we'll look much more frequently. So we'll check at least weekly in those periods. But like earlier this year, when the tariff stuff was really blowing up and stocks were swinging very violently, we were looking daily, actually, to see. And we have a lot of technology that makes this very efficient and easy to just look through all the client accounts. If volatility is high, are there opportunities to be doing a rebalance? Does it make sense to keep things in line?
It's an efficiency thing. I mean, just picture yourself taking a flight from Pittsburgh to Los Angeles. The plane eventually goes onto autopilot, and it's adjusting its route based off things that maybe they weren't aware of at the start of the flight, but they become aware of in the middle of the flight. By setting that path and only adjusting when needed, the end result is that you get to where you were going faster than if somebody was just, trying to look at a map while they're in the middle of the sky, and it'll take you a lot longer to get there. The same thing works in the investing world. The efficiency helps control the risk and returns. If your portfolio is having large upswings and large downswings, large upswings, large downswings, one, you're not going to be comfortable, and two, your returns and your risk over the life of your plan the returns might have been lower and the risk actually greater because we weren't controlling that dispersion along the way.
Schedule your complimentary review with Ryan and his team today. Just visit them online at wyzewealthadvisors.com or call 724-271-7019 to get started. That's 724-271-7019 to get started.
Ron, I'm going to kick it over to you to talk about the sixth mistake here. And that mistake is market timing, or trying to predict short-term movements based off opinion, what you hear on the news, whatever it is, which we don't feel is possible. Can you give some more context around market timing, the risks associated with that, and then how we advise our clients in this area?
Sure. So I look at it two ways to do it. One is the crystal ball approach, which we don't do. And the other way is the discipline approach, which, to no surprise, is what we do. Right. So let me go over the crystal ball approach. So ideally with the crystal ball approach, the markets are running up. Right before they fall, you sell. And then after the markets go down, you buy cheap. That's, and that's what would be great. But It's not what happens. What normally happens is we're emotional creatures, and so when the markets are falling, our primitive instincts kick in, and it's fight or flight, and we can't really fight the market, so we run away, we sell. So if the market goes down further, a lot of people don't buy because it's self-fulfilling. Hey, it went down, it's going to go down more, I'm going to stay in cash. So there's really never an obvious time to get back in. If the market goes up past where you sold, a lot of people don't want to buy back in because they don't want to pay more than they got out, right? And so the studies show that you need to be correct about 70% of the time on both sides of the equation, when to get out, when to get back in. And I can tell you from experience, that typically doesn't happen.
I mean, and think about it too, just taking it a step further. It's like, you say you sell out today, right? Well, what happens if the market goes up an additional 10, 15, 20%? Are you going to have confidence in your decision making from there? Say you decide to get back in, it's the top, the market goes down. It's like, not only have to be right 2 times, but then you have to deal with whether you were right or wrong after you made that decision, adding another level of emotional kind of influence in there, and then again being right 2 times on both sides of the equation. It's a slippery slope and very, very challenging.
People think when they get out, they relieve stress, but they just created new stress, which is when to get back in, right?
Yep, exactly.
Our process is not an all or none process. So let me explain that. So what we think you should do, especially for people near retirement or in retirement that need income from a portfolio, is have a balanced account: stocks, bonds, cash. And then we have something called an all-season framework, which we've talked about before. But the framework is set up so that if you really think about what can happen based on elections and tariffs and wars, financial crisis, COVID, the economy can grow or slow, and inflation can go up or down. I mean, that's it. And so what we try to do is position assets so that no matter what happens, we have assets in these different buckets, these different areas. So maybe something's doing poorly over here, but something's offsetting it over on this side. And we're striving to have more consistent returns that are competitive returns. And that's what the framework allows us to do. So we have this framework, and then as we've been talking about, we rebalance.
The final mistake that I want to cover is similar to the market timing concept, which is chasing hot investments. That's buying an investment only after it's experienced massive growth, or which tends to leading someone to buy that stock at a high share price. And this could be done because, hey, maybe it's something that's been talked about on the news for 3 months, 6 months, a year, 2 years, 3 years. So Ron, can you talk a little bit about chasing hot investments, again, the risks associated with that, or kind of why we see people making that mistake, and then how we're advising them in that area?
Yeah, today we're going to talk about buying popular investments, and Nick and I are working on another podcast about buying what's in vogue based on technology, new technology like AI and quantum computing. So buying stocks that are popular, what I mean by popular is that it's based on market capitalization, right? So how much the stock is worth. So you take the number of shares times the price, and that's the market capitalization. So right now, NVIDIA is worth more than, I read a study that it's worth more than every market around the world except for the United States and China, okay? And so we call the top dogs, that's the 10 most valuable companies around the world. That's the top dogs, okay? And this company called Research Affiliates, we use some of their exchange-traded funds. They provide great research, and also exchange-traded funds. And they did a study, and they looked at, you take the top 10 most popular, most valuable companies in 1980, and then you look at them in 1990, and then 1990 you look at that list and look at it in 2000, right? So every 10 years you take a look. And what the study shows is approximately 8 out of 10 stocks no longer make the list 10 years later, approximately. Only 2 survive.
That's wild.
And so by buying the moral, or the gist of this is by buying the popular stocks, you tend to underperform. So let me explain. I mentioned about the top dogs and how they are always changing. Let me explain why they change. So, first of all, competition. If you have an area of the market that's growing very nicely and is very profitable, competition comes in to take advantage of that. And so the existing companies tend to grow after the competition comes in more slowly, and the profitability tends to decrease. So the stock prices come down because the future doesn't look as good as the past. That's one reason. The second is new innovation. It's really easy to look at this one. Look at BlackBerry compared to Apple. Now, BlackBerry's really no longer around because Apple ate its lunch. And so a company needs to always stay relevant, and if they take a misstep, competition can come in and dominate going forward. And so the old companies are sometimes go out of business or perform very poorly. And then lastly, sometimes these popular companies get so expensive that future returns are above average. Future returns are very difficult to achieve. So as an example, Cisco. Back in the dot-com bubble, Cisco was basically the pipeline to the dot-coms, and it was a very popular stock, growing very nicely. It was extremely expensive. There's something called the price-to-earnings ratio. It's just a popular way of valuing a stock. It was 130 times earnings in March of 2000. The stock market throughout history has been about 15 to 17 and a half times earnings. This stock was 130. And for the next 20, 25 years, the stock really didn't move anywhere because the fundamentals had to catch up to the price.
The key with all of this is discipline, like
Right.
Ron was saying. And it's like, we work with a lot of clients that had very long, successful careers, and they got to where they were at the end of their career through being disciplined, realizing there's no free lunch, putting in the time and the effort to build a successful career. Investing is the same thing.
Absolutely.
To get the best results over a long period of time, you have to do what can be hard at times because emotions want you to do something different, but you have to do the right things consistently.
That's it.
That's disciplined.
Right.
There's no free lunch. Just like in your personal life, there's no free lunch in the investing world either. And we're here to combat those risks, educate people on what goes into a disciplined investment process, not one that's based on predictions or guesses or putting your finger up in the air and seeing which way the wind's blowing. So with that said, we hope that you found this episode informative. For our clients listening, if you have questions and you want to further discuss anything that we went over in this episode, please do not hesitate to reach out to us. Per usual, if you could keep the topic ideas or the questions coming. We've had some great episode ideas come directly from our clients, so please keep that coming. And if you could like and subscribe to the show, we would greatly appreciate it. I hope you found it informative. Thank you.
This episode's content is for informational purposes only. Opinions expressed herein are solely those of Wyze Wealth Advisors, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by our firm as to other parties' informational accuracy or completeness. All information or ideas provided should be discussed in detail with an advisor, accountant, or legal counsel prior to implementation.